Hello. Yes, good afternoon, everybody. I hope you can hear my voice and at the same time see my screen clearly. So today's webinar, I'd like us to look at something really important. I want us to look at a very simple but yet profitable strategy, something which I've been following up for some times now. I think I've monitored for the past 2 years, and I think it's something which is very constructive, something that you may want to try, especially in your live trading. You may want to see exactly how the price does, as in what the price does, and how you can use that to your advantage. So I already have an indicator on my screen. I have some indicator. This is a custom made indicator. It is based on the break of structures. You may have it, I think it's there by default on some platforms, or you may just download it online. If you get it online, it's also good. It's just the same thing, but I'm going to explain to you how I came about it. When I say it's there by default, I don't mean that you'll get it as a standard indicator with your broker. No, it's not there as a standard indicator. You have just to develop your own ways of getting it, but I want to explain to you how you can maneuver your way around it so that you get it. So this strategy is very useful. Irrespective of the time frame you're trading, it's very good. As long as you have an active trend, it can still be very useful for you. So if you're looking at the 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, 1 hour time frame, or even as high as the daily time frame, it may still be very useful. So the first things first is you have to know the trend where the price is going. You have to know, are we downwards? Are we upwards? Are we on which direction is the price heading? So it may be difficult for somebody just to say, okay, the price is down or the price is upwards. But if you use an indicator, then that will be very good. So that is where the indicator comes in. The indicator I'm going to use to identify the trend, there are several, but I'm going to use just two. I'm going to use the moving average. At the same time, I'm going to use stochastic is not a trend indicator, so don't get confused. I'm going to use how do you call it? I'll use stochastic, the moving average. I'm going to also use Bollinger Bands. Then at the same time, I'm going to use the zigzag indicator. So we're going to use the zigzag not entirely to show us the trend, but to show us where our stop losses and the take profits are supposed to be. That is why we're going to use the zigzag. And we are also going to use the moving average for trend and Bollinger Bands for trend. So I'll start by first putting Bollinger Bands on my screen. I'm using it with the default settings. This is just the default settings. This is how it looks when you use it on the default settings. It looks a bit confusing. So we have this. This is what we have on our screen. I'm going to make it a bit wide and darker so that we see exactly where the lines are being drawn. You can now see it's now a bit more clearer. Then I'm going to add the moving average, 200 period moving average. 1 second. So to add an indicator, just go to insert and then you go to trend indicators. Then you'll find the moving average. You give it a period of 2. It should have a method of simple. Then you should apply it to the close price. The color of this moving average is going to be red. So you can see how it looks. This is how it looks on my side. You can see it looks a bit confusing. Let me change it to high price instead of close price. Yes, now it's a bit better. Okay, so how are we trading this? It may look a bit confusing because there are several lines on your screen. If you're new to trading, you may be wondering how comes we have such number of lines on our screen. Now this is, if you know how to analyze it, then you'll get it better. So let me explain something. The idea behind the whole thing is to trade when the price is above the higher level of the Bollinger Bands but below the moving average. So like somewhere like this, look at this point here. look at this point here. We had some very good downtrend. This is the middle line is actually downwards. At the same time, we have the price being above this below this moving average. So this is a downtrend. From this point you can see we are completely headed short, and then here also we have a downtrend completely headed short. Then the downtrend is ending, it's like if you check the angle of slope for this midline, it starts to decrease, and it started at this point here. So here the angle is declining, it continues to decline. Then at this point here it now begins to level, then it starts to reverse here naturally to the upper side. So what happens is, anytime we have a slope of this midline, it's sloping downwards. At the same time, the price is above this moving average. This is also sloping downwards. Then that is a good indication that we are now downwards. For example, we have this point, the midline is sloping upwards. That's not a good place to look for a trade. It's not a good place to look for a buy, because it is against the overall trend. Then from this point, it begins to slope downwards. It slopes downwards, slopes downwards, slopes downwards, and it goes up to this point here. When this is happening, you can see we had, like, this is showing us downwards here, and this showing us upwards. Then from this point, this now begins to show us downwards, and at the same time the moving average is also showing us downwards. So at this point, at this very instance, it's usually the correct time to start trading until when we have the slope ending on the midline or on the lower line. So since now we are using the midline for a downtrend, to gauge that we are still in downward trend, we will be using the same midline to get out of the trade. So that would be somewhere around this level here. Then when this happens, we step out of the trade, and you can see, even though it's now bearish, it's not as slopey as when we had it between this point here. The same thing we had here. So this one, the trend actually started somewhere here. You can see we had a very good downtrend. It went there, we had a downtrend there, and then we had another downtrend here. This is based on the moving average, the midline of the Bollinger Bands. We had a downtrend at least up to this point here. So you can see technically that anytime the price is above this moving average, the moving average is below price, and at the same time the midline is sloping downwards, that is a very good indication that we are now heading downwards. So remember that these are two periods. The Bollinger Bands, the period I'm using is 20. The deviation for that Bollinger Bands is 2. I've applied that to the close price. If I apply to high price, it shifts a bit, but still almost the same thing. So this is how I look for a sell. So I look for a sell. Here, the example we had before, I look for a sell. This is where I'm supposed to get out. Here, I cannot buy, even though this is steeply to the upper side. I'll not buy it because the moving average is opposite. Then here, I'll be interested in a sell because the moving average is showing us a sell. At the same time, while this is showing us a sell, we have the midline of the Bollinger Bands also showing us a sell. So that is a very good indication that we are in a very good downtrend. So we're supposed to pick a sell position, and we sell only up to the point when the slopiness of the midline begins to change. Like here we were very sloppy, it changed somewhere here. It again continued very sloppy, then it changed somewhere here. So when this happens, when you start seeing this change, you automatically know that the downtrend which we had previously is beginning to change, and therefore we should not be focusing on sell positions. We're supposed to be focusing on trades that are opposite of the other one, especially if the moving average also closes below where the price is. Does that make sense what I'm saying? So if the moving average now closes below where the price is, then that will be a very good indication that the trend has changed. Now we look for the moving average, we look for the midline of the Bollinger Bands to start sloping upwards. Then now we focus on a trade from that point. So you can naturally see where the price is going just by observing some few indicators. If you know how to monitor the moving average properly, you can see clearly that we are in a given trend. For example, let's check something else on another chart. You see here. So on this chart, if we said that we're supposed to enter based on the moving average and the midline of the Bollinger Bands, then possibly we could have started trading after this point here. After this point, and at that very time when you're starting to trade, it's like here the price goes down, goes, the moving average and the stochastic and the midline of the Bollinger Bands, they both continue downwards, and then here we have a reversal. So even if you say that this was a losing trade, you didn't lose as such because you had an opposite signal start to show up just before you had held on to that trade for a longer time. So the fact that you are able to see this reversal here and you stepped out here is a very good sign that now you're supposed to, you've not lost as such, you've not lost as much as such. At the same time, you've not won anything, but the loss is small compared to if you don't know exactly what's happening and you had maybe your stop loss there and you have your take profit somewhere where you don't understand exactly what's happening. So the examples I've looked at right now, those are sell examples. They are sell examples. I want us to look at, there are many, there are several. We have others here, go up to this point. We have other cells here, they continue up to somewhere here. We have some cells from this point up to where it begins to level. We have a cell up to this point here. So if you just follow strictly, what I'm saying, you will find places where the price will do exactly as you want it to do. The price will do exactly as you'd love it to do, because it will, like here we would sell up to this point and then we get out. Some places we would sell, the price would not go as much as such, but then the way you'll get out of the trade, those trades you lose less than if you're just trading randomly. Like here, we would start selling from somewhere here, then we get out somewhere there. That's too far. Actually, we'd get out somewhere here, because this is where the low moving average begins to level up. So you can get out based on this low moving average on lower Bollinger Bands band, or you can get out when the middle band begins to level out. Those are the only two occasions that you can step out of a position. So this is one way to trade based on the Bollinger Bands. The other way is you may increase the period to 52. You may include the period to 52. You may increase the period to 52. The Bollinger Bands right now, its period is 52. You may increase the period to 52, and then you add an oscillator which shows overbought and oversold areas. So we'll add the RSI, that is relative strength index. We add the RSI. So with the RSI, I use the default settings. I'm not changing anything. So let me now explain what I want to say. You trade when the price is overbought both on the Bollinger Bands or oversold on the Bollinger Bands, and at the same time the same thing is happening on the RSI. So what that means is this. Look at this case here. Here you can see what happened. We had the RSI being oversold here. At the same time, the Bollinger Bands was below the lower band, which is this one. So we have overbought, oversold area. At the same time, we have oversold area here. Usually, this is the best time to look for a trade. Whenever you have the Bollinger Bands showing you the same thing you're seeing on an oscillator, it means this is showing us oversold. At the same time, this is showing us oversold. Normally, the bands mean that the price will be contained inside these bands, the upper band and the lower band, such that when the price breaks any of them, it's running to the oversold or overbought area. In this case here, we had an overbought area, oversold area. Here we had the same thing. We had oversold, but for some reasons the price did not go upwards. It didn't reverse upwards. That can happen at some point. It's not necessarily all the time that we have overbought or oversold that the price will do exactly as we want it. So we have that. We have here, we have overbought here based on the RSI. We have overbought there. At the same time, we have an overbought here. So this is usually the ideal time to even think of a trade. It's usually the best time to think for position, because whenever you enter like this, the price has to go at least some 10 pips your way before you can get out of a position. We have another one. He had overbought. Overbought means the price has gone up in excess. Have that, and then you have another one. We have another one. We have that one. Then we have this one near touch of the overbought level, and then you have another one here. So I hope that makes sense. Let's get another one. We have this one. So we have overbought. If you are somebody who understands how Martingale works, then you may put the points which are marking as the best entry places, because they normally indicate that the price is likely going to reverse. So the person who's trading Martingale will already know that, okay, if I enter a sell here, it does not work. I'll also come and enter a sell on the next overbought level, which is this one. So if the first one do not work, if the first one fails, we move straight to the next one. And then we try another one here. So we have this and we have this one. So the first Martingale trade will go here, the next one will go on the next slot. So this one, we don't see any other overbought area, so this is now a good sign that we're supposed to continue downwards. And now that's a good one. We have another one here. This is very good for someone who understands the concept of Martingale, because you'd enter trade there, at the same time you'd come and enter here, and since there is no any other point at the above it, you'd wait for price to again reverse downwards before you get out. Then we have So that is just a way to look at the Bollinger Bands. I've not been able to look at the zigzag indicator, but I will look at it the next time. That should bring us to the end of today's webinar. I'm hoping to see us again tomorrow, next week at the same time. So thank you and see you soon.